Welcome to another edition of Matt's Markets on the Move, brought to you by SHP Financial. I'm your host, Matthew Peck. And when we have these special editions, usually it's sort of a bearer of bad news. Whether it was the Russian war back in Russian-Ukrainian war in 2022, COVID, any bear market, you're going to be seeing my face and my voice a little bit more than you care to. But that's our role here at SHP Financial, is to break down what can be very complicated and scary events into sort of more digestible bites and things you can understand. But also, kind of what we're monitoring and what to expect, whether it's this particular conflict or the many conflicts to come in the future, recessions, bear markets. It's all part of the package when you are a long-term investor. So let's start with the Iran war. Some are calling it the third Persian Gulf War, whether you go back to the original George W. Bush, and now our third sort of major commitment in that area in recent history. And it's been obviously a volatile one and also a very monumental one. On February 28th is when the bomb started to fall as Operation Epic Fury began. I'd love to have a separate podcast on some of the geopolitical and historical events that are happening, but I'll do my best to keep it focused on the economic and market fallout of those actions. And so let's start with that. The bomb started to fall, and immediately Iran did what it sort of had its tools at its disposal, which was to close the Strait of Hormuz. And because I am a nerd and a geek, I'm going to sort of show everyone where on the map it is. Because when these type of conflicts do happen, we get to pull up the map and figure out, okay, what is happening and where. So for all of our visual listeners, here it is right here. Here is the Strait of Hormuz. In this little area right here, I'll kind of zoom in. You have a very narrow choke point, where Iranian mines or speedboats or missiles or drones can easily attack this strait. Basically, 20% of the world global supply flows through this little choke point right there. And so when the bomb started to fly, let me stop sharing right there. Here, I'll zoom out a little bit just so everyone kind of give an idea again of where we are. But when the bomb started to fly, Iran immediately closed that, because that was one of their largest sort of levers of power or retaliation. Besides, of course, sort of flailing out at other Gulf states, the biggest pain point for them was the Strait of Hormuz. And so suddenly, 20% of the global world supply is offline. On the left-hand side of that strait, you have all of these full oil tankers that are looking to pass. On the right-hand side of the strait, or the eastern side of the strait, you have all these empty tankers that are waiting to pass through to get fueled. And some have said, okay, can't they just run the strait or whatever that may be? But I mean, we are talking about a slow-moving, highly flammable tanker going through a war zone. So, not unsurprisingly, a lot of the owners of the ships are not taking that risk to run the strait. And so, to kind of even give it even broader terms, according to the International Energy Association, what happened was the largest supply disruption in the history of the global oil market. That's going to leave a mark. And to kind of give you some other visuals when it comes to how much of an impact this was, let me sort of share here. Let's go from Strait of Hormuz. This is from Barron's. On the left-hand side, it talks about the daily traffic of oil and chemical tankers, through that particular spot. Again, plummeted. And then here's the price of oil. And I'll go even further to kind of show what's happened with that price of oil here, according to Yahoo Finance. You'll see for over the past 6 months, oil itself has been up 47.9% as it sort of, has been skyrocketing. And as I said, that's going to leave a mark. That type of impact on the global, because it's not just, let me stop sharing real quick. Because it's not just oil that goes through that particular strait. It's fertilizers, it's liquid natural gas, it is helium, It is things like aluminum, sulfur, ammonia, urea. Like a lot of commodities, not just oil, is going through that choke point and is being stopped, which is going to have a huge effect on the global economy, all in so many different directions. Okay, so now let's start with American impact, or the impact on the USA. The first thing I want to begin with is that this is not the 1970s. Back in the 1970s, 5% of our total spending was going towards oil and gas. Now it's down to 1.8% of household income will go towards the price of the pump. Okay. Also, what is crucial to understand about the difference between the 1970s and today is that the United States is a net exporter of oil. So when oil prices go up, like we saw, close to 50%, recently, well, that is very good for the oil industry. That's very good for companies like Exxon and Chevron, or some of the fracking companies that are again domestic. So it's and for all the workers, obviously, that are employed in that industry. So on one hand, you have the consumer who is spending, close to only 20% of what they used to spend on oil when it comes to past crises, like the 1970s. But you also have a boon to a certain American economy, or a certain sector of the American economy. But it's not all sunshine and lollipops in America. For one thing, when gas goes up, that obviously consumers will still feel it. Yes, it might be less than the 1970s, but consumers will still feel it as they go and fill up their gas tanks, weekly or whatever that may be. And that's going to hurt, just consumer or discretionary spending. Secondly, as I said, oil, it's not just oil that's flowing through the Strait of Hormuz. It's fertilizers, which might cause food prices to go up. It's helium and different metals, which will cause petrochemicals and different sort of automobile parts, or these are the elements that go into a lot of manufactured goods. That's also could go up as well with the closure, or at least the restriction on the flow. So you have spending that's hurting. You have rising costs of inflation, or triggering inflation. That's what I should say. All these potential rising costs, are going to be adding to that, and so it's also now happening at a very precarious time for the U.S. economy. The GDP in Q4 was revised down to 0.7%. So we can have a sluggish economy when it comes to our GDP based on Q4 readings. And then also, as of February, there was 92,000 jobs that were lost in the month of February. And so the inflation, or now that we have higher gas pumps, prices at the pump, now that other things might stoke inflation, such as other goods or food, with fertilizer and whatnot. And then also, lastly, you have this war will cost money, and so the deficit will get worse, or that the United States will have to borrow more, which causes interest rates to go up. And so now we have a sluggish economy that's now paying higher prices at the gas tank, potentially at the food shopping, and for goods. And then you have interest rates going up. What all of that means is a word that does ring true, or potentially rings true to the 1970s, and that is the term stagflation. A stagnant economy, a sluggish economy with inflation, higher costs at the pump, higher costs at the stores, and things along those lines, which leaves a very tricky situation for the Federal Reserve. And so the Federal Reserve, normally in a situation like this, if we start to get stagnation, if we start to get heading towards recession, heading towards lack of hiring, how do we juice the economy? How do we get it going again? How do we get it out of its doldrums? Well, they would cut interest rates, and that would get things flowing again. However, it's not going to cut interest rates if inflation is high, if inflation stays elevated. And as I mentioned, all of these things, the closing of the strait, will lead to inflation. Imagine that situation on steroids. And that's actually what's happening internationally. A lot of countries, India spends 3% of its GDP on imported energy. Japan, South Korea, close to 90% of Japan and South Korea's energy needs are imported and come via the Gulf. And those companies are crucial for the global economy. Because think of Taiwan, for example, all of those chips, all that AI chips and things along those lines that we need, and South Korea is another one, Samsung and whatnot, that are making these chips. Well, now their energy is either cut off or at least severely restricted, but the costs of getting that are going to be a whole lot higher. Where now chips are going to be higher, and whatever spending that the countries like Korea and India and Japan are having to sort of manage are now going to be a lot more higher. In Europe, natural gas prices peaked at a 75% increase. So if America is seeing a 50% increase, or if the world is seeing a 50% increase in the cost of oil, England or Europe in general is seeing a 75% increase in their gas supplies. Another area that is an importer of oil and of energy. So as I mentioned about what's happening, or the concerns that are happening in America of stagflation, right, of a stagnant economy and higher costs, that thing is happening supercharged or turbocharged in Europe, in Asia, whether it's the developed markets in Asia or whether it's the emerging markets of Asia. So this is why it can and may be extremely precarious, and why the markets have reacted and why volatility has spiked. Okay. But then, interestingly enough, and let me kind of share a graph with you. Interestingly enough, the markets haven't responded in too dramatic of a way. So if you see this, you see the area that, like, okay, it peaked around February 25th, and the markets have come down. But if you go all the way out to today, or as of this recording, the NASDAQ is only off about 0.5%. International is off 3%. Like I mentioned, it's obviously a stronger fall because of their importing needs. And then the United States is only off roughly about 2%. So why hasn't the market reacted as strongly? If we're talking in terms of things like stagflation, and stagflation sort of like replaced some of the concerns of AI eating up software, AI eating up the world. And we'll come back to both of these, anecdotally, we'll come back to both of these market issues in the next couple of weeks on the longer Matt's market on the move. But back to the Iran affair and the Iran war. Why are the markets not responding as much as you'd expect with stagflation and these issues that are happening in the international markets? Well, for one, the markets do not expect that this conflict is going to last very long. And there's multiple reasons for that. In fact, you've started to see a slowdown already in some of the action, whether it's the United States, an extremely powerful and efficient military, knocking out thousands and thousands of sites. So once you've bombed a lot of the military areas, you kind of run out of targets. Also, the drones and some of the incoming fire from Iran is also slowed considerably. Now, whether they're holding on to their missiles for a future attack or whatever that may be, but the pace of the bombs flying has started to slow. Over the weekend, you've also seen some tankers starting to come through the Strait of Hormuz. And so whether there is sort of backroom dealing and sort of back channels happening, you are starting to see a slight little opening of that strait, which is so crucial to the global energy supplies. But also, too, I think the markets are betting on domestic, on the political pressure. No voters out there is going to like going to the local gas station and filling up a tank at an extremely high rate, or going in their food now is costly. Inflation is an election killer. We all know what happened to President Biden in 2024. And we know now, or certainly there's a lot of folks in Washington that are concerned that if inflation or if those high gas prices continue, there's going to be a reckoning come November. Okay, so I think there's a lot of bets on the fact that it's not going to last as long for all of those reasons. And I think that's the crucial thing to watch here is all about the duration. How long will those oil prices last or as high? As I said, recently we have seen them come down a little bit. We saw peaking at 110, 120, and we have seen some moderation. So if we're in the mid 90s, that's still a little bit high. But if it gets down to the 70s to 90s range, that's a little bit more manageable. And if it falls even further to where it once was, which was in the 65 range, all the better. And inflation in this sort of, we'll actually use the term that the Fed that burned the Fed recently, but really the oil shock would be transitory, because yes, it might be the greatest shock ever to the global disruption, but if it passes quickly, then it would be merely a speed bump. So again, duration is the key there. But the opposite is also true. If it stays elevated, if the conflict itself does start to spread, if there's some type of miscalculation, there is risk there as well. So how long does this last? How high do the prices of oil stay? All things that SHP and the rest of the world is monitoring at that. And then lastly, too, I would point out in regards to why it's starting to moderate slightly, but obviously all eyes, we're not calling the all clear sign anytime soon, is also the ability of the markets to respond. It's like when you have this buildup, there's a lot of uncertainty, of course, and there's always uncertainty. There's always instability in the markets. It's what it is. But then once the event happens, then people start to react to it and respond to it. It's no longer, oh, what if this is going to happen, or what if the Strait of Hormuz is closed? Well, now it's occurred. And the markets and the managers and the traders and all of the world economy kind of gears up and says, okay, here's what it is now. How do we respond? And so, in fact, even though there's new uncertainties and new issues and new concerns and new risks that are being managed and mitigated and thought through, the original uncertainty of will he or won't he, or will Israel and America attack Iran, is now complete, or is now finished, right? So people get to adjust. And whether it is, like for example, they're taking a look at, okay, are there ways to bypass the Strait of Hormuz? Now, it'll certainly take time to build up pipelines and different things along those lines to bypass such a difficult situation or a strait that can be choked off. That's going to have an impact, right? Meaning that like maybe suddenly some of the people in the Iranian and Persian Gulf say, look, we don't want this oil to be misdirected or redirected outside of it, because that's going to cause us future revenue. So there are all these pressures and all these things and all these adjustments that happen. And that's just the beauty of the global economy and the dynamic and the dynamism that is there, that allows us to kind of soldier on and grind through these types of events, because wars start and wars end. And it might not be good for civilians, and it might not be good in so many ways that we never want to overlook, because there is true human suffering. There is humanitarian crises that arise from this, and we certainly never want to overlook those. However, markets adjust, economies adjust, and I think that's all part of the reason why you're seeing a shock, a fall, where we saw markets were off, close to about 7.5%. The NASDAQ and Dow were about 7.5% off of market peaks, but you're starting to see a tentative and slow recovery as of this recording. And last but not least, for all clients of SHP Financial, this type of issues are built into the plan. Uncertainty, volatility, market corrections are a feature of the markets, not a bug. We didn't know that Iran, no one knew, well, I can't say no one knew, but obviously no one here at SHP was betting that Iran was going to happen and this was going to happen. But we do know that markets fall. And those types of events, whatever the cause may be, they're built into the plans. We have diversified portfolios. We have income plans that match your cash flow needs with your investment strategy. We have tax plannings that make sure the fact that we can sort of take advantage of volatility through things like tax loss harvesting. Again, we're built for this. And I'm sure most other advisors are, and certainly if you feel, if you're listening to this and you're not a client of SHP, obviously pick up the phone. We'd love to show you how we help out and why this is built into the plan. But again, long story short is that the planning and everything that does occur, we don't know the cause, but it's built into the plan and we're ready for it. Thank you for listening and putting up with me and my little geography tour through the map there as well. I certainly look forward to getting into much greater depth in Matt's Markets on the Move on our quarterly edition. I certainly hope not to have another special edition, and let's hope that everything we mentioned, that the duration really is winding up and that we're moving on to the next stages of this particular conflict. If not, you will see me again, and maybe I'll be a little bit gloomier in my outlook, but to be determined. Future is uncertain, as they say. But thank you again for lending me your ears and your eyes and your attention. And if you have any questions, certainly never hesitate to reach out. But thank you all very much and be well.